Hello and welcome to our discussion on preparation of the financial statements series, and under that we are in a third lecture. We are continuing our discussion on the preparation of financial statements. To reiterate, every business decision will have financial item and all the financial items will find place in the financial statements. In the last discussion we saw an accrual concept, and under that we said that if expenses not paid or income not received should also be recorded, because accrual concept says record cash and credit transaction. Expenses not paid is a liability and income not received is an asset. And in this session we will continue our discussion on accrual concept with an example, but we will try to understand the concept called unearned revenue. Unearned revenue, that means advance from the customers, advance from customers. And the prepaid expenses, the firm pays the expenses in advance, so it's an income in advance and an expense in advance, and that will do going back to that Excel. So let me recap. In the first case we saw where there is no credit transactions, no credit transactions, and all the transactions were for cash, so there was no credit transaction at all in this example. In the second one we saw outstanding expenses and the credit sales, and then we saw that the outstanding expenses are liabilities, that is their salary, and the credit sale is a debtor. Because of the accrual concept, you see these items of outstanding salary and the debtors on the balance sheet. Now in this session we will try to understand the advance from customer and the prepaid expenses. The transactions are more or less same, so let me move from here that you started business, so there is a capital and there's a receipt and a source, and you have taken a loan of 75,000. You have taken a loan of 75,000, and loan is also a source and a receipt. You're purchasing stock for cash. You're purchasing stock, so 180,000 I'm purchasing stock, and the asset side on this moment you will have the stock. You can, to reiterate, I'll say that stock at the time of purchase is an asset, not an expense. You sold the entire stock on credit to Mr. X, so therefore I'm selling the entire stock, 330,000, but there is no cash flow, but there is X who is a debtor. Because of accrual concept I show that as an asset. But whenever there is a sale, there has to be cost of goods sold, and the cost of goods sold, that means the stock you purchase, will become an expense. When the stock is no more, that on the balance sheet the stock will not appear. What happened to the stock? You can see here, you purchased the stock of 180, made the payment for that, and you are selling that, so there is no stock at the end of the year. Then you paid the salaries, so salaries is an expense and you are paying that salary, so there is no outstanding salary. But just for the sake of clarity, I have created an item outstanding salary, but that outstanding salary is zero. Outstanding salary is zero because you have not paid, you have paid that money. And rent for the 3 years you paid, so 90,000 you are paying rent, 90,000 you are paying rent, but this is an accounting year for 1 year, so because of the matching principle the rent will be shown at 1/3 of this as an expense. But you paid 90,000. The excess money paid is an asset for us, so 90,000 minus 30,000 is an asset on the balance sheet, and we'll give a name to that bit later. You're receiving advance from the customer. You're receiving advance not for the current sales, but you're receiving advance, so there is a receipt of 50,000 but you're not rendering any service as of now, which you're going to render later, so or you're to sell the goods to them. So the entire advance will appear on a liability side, which I have mentioned as an unearned revenue or a liability, because you are bound to give the goods or you have to repay that money. Interest, as usual, is an expense because of the accrual concept. I show the interest. Let me remove this. So interest, okay, so interest is 12%, 1 point. Sorry for that, I made a mistake of formula. So 0.02, so 9,000, and I pay the interest, so no outstanding interest appearing. All other items are taken care. Let us find out the profit for the period. Then we'll summarize our learning. So PBT is the sales minus the expenses is PBT, and the tax is equal to, okay, the tax is equal to 30% of that, 0.30. So, and the PAT is 24,000. PAT is 56,000. If nothing is mentioned, we'll continue with our assumption. Entire PAT stays in the balance sheet as a retained profit, and since we have assumed the tax to be paid off, now all the inflows of cash are to be total, all the outflows of cash are to be total. Okay, so this is all the outflows of cash to be total. So you can see something interesting here. So there is a negative cash. So what does that mean? That means we don't have sufficient money to make the payment. So what we can take a decision either to take a loan or not to pay some of these amounts. Okay, salary, interest, and tax. Suppose I create them. Let us find out the total of that. So interest, then tax, the total comes to 63,000. That makes sense that since I don't have money, suppose we take a decision, okay, we take a decision that we will pay them later. That's not a problem, it's a business decision. So if I don't pay now, observe what happened to the outstanding salary. You create a liability. If you don't pay the interest, okay, no problem, don't pay it, but create an advance, okay, or rather create an outstanding interest as a liability. An expense not paid, an expense not paid is a liability. We also don't want to pay, okay, or don't have money to pay, so therefore we'll have outstanding tax, and outstanding tax is 24,000 minus this, which we say we will not pay now, so we are done with. So therefore you still have, that means a decision you have to take. Since we don't have money in hand or cash in hand sufficient, so we can take the decisions of not paying that expenses, provided you have planned for it properly. So salary not paid is a liability, tax not paid is a liability, interest not paid is a liability. In the same way, advance from the customer received is also a liability. So that's, and all these items appear on the balance sheet because of the accrual concept. Okay. If cash in hand, so cash in hand will become the asset if we are not wrong. Okay, so stock has changed, cash in hand, debtors, advance rent. This I will, let us total that once again. So the total will be, okay, 395,000. That means our balance sheet tallies. As a result, all the transactions have been recorded and find place in the balance sheet and income. But in the process, you might have seen that sometime while doing the accounting, you actually have to understand the business. So if you don't have cash, nothing to get worried about it. You can postpone the payments or prepone the inflows. Preponing inflows may be a problem, but you can negotiate transactions with your employees, ask them to wait. You can talk to your banker, ask them to wait, request the tax people that we are going to pay on a later date, if possible with the penalty or an interest on that. So advance from customer and prepaid expenses was the focus of our discussion. The unearned revenue is a liability, so that means income received before it becomes due. Okay, becomes due is a liability. In the same way, expenses paid, okay, expenses paid before it becomes due, okay, is an asset. So therefore, if I continue here, accrual concept, expenses not paid is a liability, income not received is an asset, and an unearned revenue is a liability, and prepaid expense is an asset. Thank you very much. We'll continue the series. We get into the depreciation in the next session. Thank you very much.